What sector rotation really tells you about the market. Sector rotation is one of those phrases that gets used constantly in financial media, but it's rarely explained properly. At its core, sector rotation simply describes how money moves between different parts of the market over time. Investors don't just buy stocks, they allocate capital to sectors. It could be technology, energy, financial, healthcare, consumer discretionary, utilities, and so on. But those sectors don't perform well at the same time. When economic growth is accelerating, investors tend to favour cyclical sectors, areas like industrials, materials, financials, and consumer discretionary. These companies typically benefit when activity is expanding, credit is flowing, and confidence is strong. But when growth slows or uncertainty rises, the leadership often shifts. Defensive sectors like utilities, healthcare, and consumer staples tend to outperform. These businesses provide essential goods and services, so their earnings are generally more stable in downturns. That shift from cyclical to defensive or back again is sector rotation. And it matters because it can tell you a lot about how investors see the world. For example, if technology stocks begin to underperform whilst energy and materials rally, it may signal that markets are positioning for stronger inflation or renewed commodity demand. If defensive sectors start to outperform whilst headline indices remain stable, it can suggest investors are becoming more cautious beneath the surface. Importantly, sector rotation often happens before broader economic data clearly shifts. Markets are forward-looking. Investors reposition based on expectations, not just current conditions. This is why watching sector performance can provide early clues about changes in the economic cycle, interest rate expectations, or risk appetite. It's also why major market tops and bottoms rarely look dramatic at first. Leadership simply starts to change. So sector rotation isn't just a technical concept, it's a window into investor psychology and macro positioning. Understanding it doesn't mean predicting every move, but it does mean you're watching how capital is flowing, not just where the headlines are pointing. And in markets, capital flow often tells the real story.